Swayam Prabha. Digital India. Educated India.
Hello and welcome. We will continue our discussion on introduction to financial statements, and we have seen that cash flow happens from operational activities and financing activities and investment activities. So, from these three activities, cash goes out, cash comes in, and eventually whatever is the net amount, that is the net cash flow. We have seen this in our previous session. Now, cash flow actually gives a clear understanding as to how the cash position is at the end of the operation, how much of cash we are consuming and how much we are generating. And money gets used up in assets, meaning that you acquire new asset during the year, you pay dividend, you make some investments, and your account receivable may go up or down. It may so happen that you have improved the recovery process of your receivable. So, in the process your receivable may go down, meaning that your cash flow is improving. Then many of these receivables may even become sticky, meaning that some of the buyers may not pay back, meaning they bought stock from you, bought finished goods from you, but perhaps their performance is not that good for whatever reason, they may not pay back, pay up. So, eventually you may have to write off some of these receivables. So, let us make these 2 points very clear. Receivable is when you sell some goods, you are supposed to receive the payment from your buyer. So, as long as you do not receive the payment, the amount that you are supposed to receive remains in your books of accounts as receivable. So, you are supposed to receive some payment from the buyers of your goods or services. That is what is receivable. On the other side, the payables, as the term means, meaning you have to pay. So, you bought raw material and you have to make payment at some point of time. If you are paying in cash, payable is not affected. Suppose you buy raw material for say 10,000 rupees and you do not pay anything. So, your payable goes up by 10,000. You have to pay this 10,000 at some point of time moving forward as per the agreement with the supplier. Suppose the agreement is that you have to pay after 3 months. So, for 3 months this amount remains in your books of accounts as payable. So, suppliers generates payable, buyers generates receivables. And if you can increase the payable, that is good for you, because you are getting goods on credit. That means you are doing business with somebody else's money. The example of Adani that I gave in the previous session, Adani is doing exactly that. They are recovering their sales profit faster than they are making payment to their suppliers. So, there is an accumulation of more than 3,500 crore rupees worth of cash with them. So, they are actually doing business with the money of the suppliers, because suppliers is supplying the goods and they are not insisting on payment, and they are selling the goods to the buyers and recovering the money, and after some time they are paying back to the suppliers. So, this is a wonderful and attractive proposition to do business. You do not have to pay any interest. Now, if you are cash positive and you do not really need this money, you can make bargain with the supplier, make a trade off that you supply at a lower rate. I am going to pay you in advance or earlier compared to what about we are doing today. So, you may actually end up making more profit. You can translate that cash into profit. So, you can see that you can improve even competitive advantage. You can buy at a lower rate if you can manage this too wonderfully well. Even if you can delay payment of electricity, payment of anything, most of the companies try to do that. You can actually increase your margin, whether it translates into profit or not, but you increase the margin, you reduce the cost, and eventually will improve the margin. The fundamental and critical question to answer is how much money it will take to get the venture started. Suppose you want to start a new business. So, when you start a new business, you ask this question, how much money it is necessary. You have a wonderful idea. Now, you think that this idea is going to translate into a profitable business. So, you start working on that. After working for a few months, you realize that this business requires an investment of say 50 crore rupees. You may not be able to arrange that 50 crore rupees. So, even before investing anything in the business model, in developing the product or doing some market research, you need to have some idea about the scale of investment that you need to make to start this business. If you see that is affordable, suppose for an example, you want to start a mini rice mill. A mini rice mill requires an investment of something like 50 lakh rupees. So, you know, okay, 50 lakh rupees, you get a technology from somebody, some new technology, innovative technology that reduces the fuel cost and improves the say polishing or something, and maybe it's brown rice that you want to manufacture, and brown rice price is high, and there is specific demand for brown rice because brown rice is very healthy. So, now you have an idea that okay, it is going to require 50 lakh rupees of investment. Suppose you want to put a mini steel plant. A mini steel plant on the other hand may require something like 10 crore rupees. If you want to put up a small say a spark ignition furnace, it is called arc ignition furnace, then you need more than 10 crore rupees of investment, a small furnace. Blast furnace normally is very big. Or say you want to put up a grinding plant for cement grinding unit, meaning you buy clinker from somebody and then you grind it and package it and sell. Here also you need nothing short of 10 crore rupees of investment. So, if you cannot really think of arranging 10 crore rupees, you will never ever embark on that. So, first thing you need to know is how much money you need to invest. Now, before we really discuss all of this nitty-gritty, let us start a very simple business, and that is easy for you to perceive, to understand what happens inside the business. Suppose you start a stationery shop in your hostel room. Suppose you are a student and you are residing in a hostel, and you see that majority of the students go to marketplace maybe in the evening time to buy stationery. So, you think that this is a wonderful business proposition because they have a pain, they have to go to marketplace to buy, and market is not always open and someday it is closed. So, you can maintain some inventory that they can come running and buy and just start without disrupting their studies. They can continue the business, continue their studies. So, you think that this is going to be a wonderful business. Now, let us see this small business, this just keeping stationery in your room. So, what do you think you may need to start this business? At the very minimum, you need the inventory. Inventory means the goods that you are going to sell, which will remain in stock with you, and customer will come, students will come and buy. So, inventory is nothing but this movable assets that you have, the assets that you buy with the objective of translating into finished goods and sell. If you are a retailer, then you do not convert that into anything. You buy from one end, you sell on the other end. So, you buy maybe pencil, maybe pen, maybe books and other say notebooks, etc., and then you want to sell that, you do not want to manufacture anything. So, whatever you buy, these are your inventory. So, you need to buy inventory, because you need to maintain some number of pens, some variety of pens and pencils, and then sharpener, and then whatever you see normally in a stationery shop, maybe some books as well, some high moving books, meaning books which are normally textbooks and students normally buy them. Now, what else do you need? You may actually think of buying a counter, meaning there will be a counter where you will place the items before they buy, they can inspect it there, and then they can make the payment, they can put the money on there, and then there will be a drawer from where you will bring the change and then pay, and then put the cash that the customers are going to give you. So, you need a cash, kind of a cash counter where you can keep the things. You also need some kind of a rack to place it in a very orderly manner, so that you can place the pens at one place, pencil at another, then some loose sheets at some other place, so that it's easily accessible, etc. So, you need to make some investment on the racks, you need to make some investment on the cash counter. If you think that you need some kind of a calculator for creating an invoice, some nowadays some machines are available, just punch some of the buttons and a bill comes out, you can give that printed bill to your customer. So, you may need that machine as well. It is a very simple context. Now, out of all these that I said, you need inventory of stationaries and you need these racks and all that. Try to make a distinction between distinction here. See, the racks that we buy or say fabricate with the help of a carpenter is not for sale on a daily basis. You do not sell racks, you do not sell your counter, you do not sell your computer that you use for generating the invoice or receipt, money receipt. These are to facilitate your business, these are not really for sale. You may sell that at some point of time when you no longer are interested to do the business, or maybe you want to replace them with a better one, but that is a very special case. That is not a regular business of your business. Your business is to sell the stationaries. So, these items that are not for sale, but that you have created as part of your business, these are part of your business, these are part of your total assets. These are long term assets, they are called fixed assets, these are not for sale. Whereas, the inventory of things that you have procured, like pen, pencil, notebooks and other things, these are meant for sale. You want to buy them today and then you want to sell them immediately or day after. The sooner you can sell, you can convert your goods into money along with some profit, so you make more profit. So, for any businessman, their priority is to sell as quickly as possible. They will buy it now, even before it is hitting your store, if it can go to somebody else's store and money comes in, is the best option. So, you want to sell them. That is why they are not long term asset, they are short term asset, but they are asset nevertheless, because they remain as inventory with you. You have invested money, anything that you have invested money remains as an asset for you. In that sense, even loss is an asset, because you have already invested to create loss. Loss is to be funded. So, you have funded that. So, as long as that loss remains in your balance sheet, it remains as an asset. We will discuss that more some other time, but for the time being, you try to make a distinction between liquid asset or current asset. These are the technical term is current asset. The inventory is part of the current assets. The racks and computers are part of the fixed asset. Fixed assets are not meant for selling on a day to day basis, whereas current assets are to be converted into money, into cash as quickly as possible. Inventory is one of the form of current asset. The other form of current asset is receivable, meaning that you have sold the goods, somebody has to yet to pay you money. So, somebody has to pay you money, you are going to receive money. So, that is another asset. another part of the current asset, because you are expecting the money any day, maybe within 3 months, 1 month, 2 months, and some of the payments are already matured, due, because you sold 3 months back and today you are supposed to receive the money. So, these are all assets, because their money is going to come in, but more importantly these are current asset, meaning they are current in nature, they are liquid, almost semi liquid in nature. So, these are part of current asset. Even the cash that you have is also a form of investment in cash. So, cash also is an asset and it is the most liquid asset. So, it is part of current asset. Payable on the other hand is a liability, current liability, because you have to pay it within 3 months or less than 3 months. So, whatever you have to pay back immediately are current liabilities. Like suppose you borrow money from bank to purchase this computer or desk or racks. If you borrow money, this is called term loan, meaning the loan given for creating long term assets or fixed asset is given on a long term basis. You borrow money today, the bank will say, okay, you repay in 3 years time, do not repay everything tomorrow or in a month or in a year. You pay on equated month installment scheme. Every month you pay something, next month you pay something, at the end of the quarter you pay the interest accrued on your loan. So, gradually your money will get repaid, but as long as or the amount that you are yet to pay back to the bank remains as a long term liability. It is long term because it is not immediately payable, liability because you have to pay it. Then there are bank loan which is short term in nature. Suppose for maintaining your receivable, maintaining your raw material stock, everything, suppose your suppliers are not willing to give you on credit. So, you need the money from some source. Suppose you borrow money from bank to buy raw material. So, you are borrowing money to buy current assets, raw material is current asset. So, any money that you borrow to create current assets, they are short term liability. So, bank gives two kinds of loans. One is long term loan, they call it term loan. Another is short term loan, normally they call working capital loan. This whole operating cycle management requires working capital loan or short term loan. That is, bank says this is working capital loan. Now, let us consider that your counter that you need computer or say cash counter is 500 rupees worth, and the rack where you keep all your goods is 600 rupees. You want to have a chair, because suppose you want to hire somebody, some less educated guy, and he is eager to work in your shop. So, you can buy a chair for him. So, these are all the assets that you need to long term assets that you need to procure to start the business. You can start without them, but you want to be a formal businessman. So, add them up and you have 500 plus 2000 and 1000, 3000 rupees. So, your total investment in creating fixed asset is 500 plus 600 plus 400 is total 1500 rupees, sorry, this is subtotal. So, 1500 rupees is the total requirement to create fixed asset. Now, suppose you want to purchase material of stationary item like pen, notebook, etc., and you want to invest 5000 rupees before start of the business. Now, there is no receivable, there is no goods in process. For a retailer, there is no goods in process. So, you need 5000 rupees worth of stock to be maintained, so that somebody comes in and asks for something, you should be able to give him, sell it to him. So, you need 500 rupees, 5000 rupees. You also think that if somebody comes and gives me a 5000 rupees note, I should not tell him that I do not have change, at least 500 rupee note. So, what you want is you want to maintain some change of 500 rupees, maybe 1, 2, 300 rupees note, 1 to 50 rupees note, etc., etc. So, you need 500 rupees worth of cash. So, you need fixed assets of 1500 rupees, you need current assets of 5000 plus 500 rupees. So, 5500 rupees, 5000 rupees of inventory, 500 rupees of cash, 5500. So, total requirement of money to start this business is 7000 rupees. Though the example is so simple, you should get a fair idea how any entrepreneur should estimate how much money they need to start this business. You need some money to create fixed asset, some money to create current assets or working capital money. So, long term or fixed asset, short term or current assets. Fixed assets are long term. The assets that you have procured like rack, like cash counter and the chair are fixed assets. So, give a sharp look at all these items to make a distinction between current assets and fixed assets, because many for understanding balance sheet or for preparing balance sheet, making this distinction is absolutely necessary, and if you cannot do that, you won't be able to prepare a balance sheet. So, remember that fixed assets are procured for a long term with a long term perspective, that they will remain in the business for a long term period. Current assets are procured for a short term, on a short term perspective, and they are supposed to be sold as quickly as possible. So, these are current assets or short term assets. Now, you need 7,000 rupees, you have seen that. So, you look into your purse or maybe bank, and then you find that you have 3,000 rupees in your bank, and you do not need this money immediately for paying mess bill or anything immediately. This 3,000 rupees is surplus money, but then you need 7,000 rupees. So, you approach to a friend, can you give me 4,000 rupees, I will pay you back in some manner, whatever. If you tell him that I will pay you back in monthly installment of say 100 rupees or 500 rupees every month, so you will get your payment back in 8 months or something. If you say that, that becomes a long term borrowing. Even if it is normally borrowing for more than 1 year is long term. So, let us not confuse that. So, 1 year and above will be long term borrowing, below 1 year or 1 year will be short term. I will make some amendment. More than 1 year is long term, 1 year and less than 1 year is short term. Suppose before starting now that you know that you have to borrow some 4,000 rupees from a friend, and you have 3,000 rupees of your own money, you need 5,000 rupees worth of stationaries, and you need 500 rupees worth of cash. Now, you can actually start the business. So, before you start the business, you can prepare a balance sheet. That balance sheet actually has two sides, assets and liabilities. Liability sides have two distinct major items. One is liabilities, another is owner's equity. Owner's equity comes under liabilities because you have to view owners from the perspective of the business. From business point of view, owners are outsider. So, whatever money the owners are paying to the company in the form of equity, the business has to pay back to the owner, something like that. So, they do not really have to pay back, because any business is a going concern, meaning that it will run perpetually for endless period. So, owners will normally not ask the company to pay back the money, but they will get the dividend nevertheless. Now, you know that the liability side has two major components. One is liabilities, another is owner's equity, whereas asset is asset. But then there are some sub items. Asset has current assets or short term assets. At the same time, asset has fixed assets or long term assets. So, assets has two components, current assets, fixed assets. Liabilities, as I said, there are two components, one is liabilities and owner's equity. Liabilities per se has two components. One is current liabilities, another is long term liabilities, not fixed liabilities, but they normally call long term liabilities. Now, with this money, let us see how they are placed in this balance sheet. Normally, balance sheet starts with asset first nowadays. Earlier it was different. Earlier it was a T-shaped balance sheet with the assets remaining on the right hand side, liabilities on the left hand side. But nowadays it has taken the form of a column, and assets are mentioned first, liabilities are mentioned later, and the most liquid items are at the top, and gradually the lower or less liquid items appear. So, first item, cash is the most liquid, as I said, that is why cash comes first. So, balance sheet starts with cash. Balance sheet starts with asset, under asset it starts with current asset, under current asset cash is the first item. So, your cash is 500 because you started the business with some money of your own, some money of your friend, but you have actually spent money to buy the rack, to buy your chair, buy computing device, and you bought some inventory also. So, whatever is left with you in the cash form is only 500 rupees of cash that you are left with. Of course, you brought everything in cash, but then you bought that. Now, there is the cash is no longer there, it has been consumed, only 500 rupees worth of cash is there. How much of then comes in the current asset comes account receivable. These are the items under current assets. Account receivable arises when you sell something and that buyer is yet to pay, but now that you are yet to start the business, you have just procured everything and you are going to just start the business. So, before you start the business, there will be no receivable, but then you have inventory, you have already bought 5,000 worth of goods. So, inventory is 5,000. Remember, inventory means the stock of all the current assets that you have procured to run the business. It does not include the fixed assets, the racks or any other fixed asset for that matter. Now, we go to the fixed asset part. Under fixed asset, you have furniture, fixture, you have all that you have bought is furniture, fixture, you do not have a machine, you do not have anything else. And we have seen that the subtotal of the furniture and fixture is 1500 rupees. Of course, writing them separately would have made sense, like whatever is for chair, for cash counter and for racks, because all are furniture, so we have clubbed them together. So, total of asset is 7,000 rupees. Now, liabilities. Under liabilities, as I said, we have current liabilities and long term liabilities. Current liabilities are those which are to be paid immediately. Long term liabilities are those which are to be paid gradually moving forward. Now, under current liabilities, we have accounts payable, the guy who has supplied us material and we have to pay him or her back. So, that is very current in nature because he can demand any point of time. So, that is current liability. We are yet to start a business. We have bought inventory worth of 5,000 rupees, but everything we bought on cash. If we would have bought, say, out of 5,000 rupees, say 3,000 rupees would be paid in cash and 2,000 rupees would be in credit, then account payable will be 2,000 rupees in the balance sheet, whereas inventory will remain 5,000, but then account payable will be 2,000 and cash will go up by another 2,000 because you have not used the 2,000 rupees cash because you got a credit of 2,000 rupees. Short term bank loan also is current liability, but then we have yet to raise any bank loan. Long term liabilities, all that we have borrowed is the 4,000 rupees from our friend that has been borrowed. There is no bank loan, long term bank loan. So, your friend gave 4,000 rupees, that is the long term borrowing. Owner's equity, that means the money that you have invested. You have actually invested 3,000 rupees out of the 7,000 rupees that was necessary. We have seen that. So, you complete the balance sheet, your total liability side including the owner's equity is 7,000 rupees and the asset side is 7,000 rupees. So, the balance sheet is fully balanced. Remember, the balance sheet will always be balanced. Why so? Because the liability side is the sources of money. Whatever sources money comes from are mentioned in liability side. Look at that, account payable. Accounts payable is you are getting goods on credit, so that is a source of money. So, you are getting goods rather than cash. Short term bank loan is a source of money, long term bank loan is a source of money, other loan also source of money, owner's equity also source of money. So, these are source of money, and the asset side represents the utilization of the very same money. Whatever money you receive from whosoever sources, where you are keeping this money. So, you bought furniture for 1500, you bought inventory for 5000. So, you bought goods worth of 6500 out of the 7000 rupees of cash. What happened to the rest of the cash? That is still in the form of cash. So, cash 500 and rest of the things. So, 7000 plus 7000, meaning the balance sheet is balanced. If it is not balanced, that means there will be some sources for which you have not accommodated for utilization, or vice versa. So, you have now started the business on the 1st of April. Consider that on 1st of April you have started the business. Before that you have just completed the purchase. Soon you realize that there is a good demand and that you own your own, and means that you want to hire a person, say with a monthly salary of 5000 rupees. As I said, that you have classes to attend and the sales are good. So, you think that you can afford to pay salary to a person, provided somebody, means if somebody is sitting all the time in the counter, there will be a lot of sales. With this understanding, you actually hired a person. So, let us see at the end of the year what happens. The moment you start the business on 1st of April 2018, you start selling. Students come and then you sell, you get money. Some people tells you that I will pay tomorrow, day after, and then you give them on credit because they are all friends and you know them that they are not going to run away. So, your receivables go up and your sales also go up. Your cash position also moves up, because every day you are selling, you are getting some cash, but then cash goes out when you buy paying cash, and sometimes you buy without paying cash also. If you buy without paying cash, you are actually generating accounts payable. You have to pay them at some point of time. If you are selling on credit, you are actually creating accounts receivable. At some point of time, you will get back the money. So, suppose at the end of the year or during the year, these are your transactions. What are they? You have sold 5 lakh rupees worth of stationaries, and that is meaning that at the end of the year you are looking into the different general ledgers. So, you have a ledger called sales, and you have made a total of the ledger, and you found that you have sold 5 lakh worth of goods. Then you look into the purchase ledger and you saw that you have bought 2,50,000 worth of purchase. Then you look into the salary ledger, you found that you have sold you have paid 60,000 rupees worth of salary. Your rent is 12,000, your closing stock is 10,000, meaning that at the end of the period on 31st of March, what is closing stock? 31st of March, you take inventory of the entire stock, whatever is left. At midnight on 31st of March, you think that today is the end of my first year of business. So, let me see how much of the stock that remains unsold. You started with a stock of 5,000 rupees that you remember, but at the end of 1 year of operation, during the year you bought a lot of stock, you sold a lot of stock. So, from one end stock came, from the other end you sold, but you sold 5 lakh rupees worth of stock, whereas you bought 2,50,000 worth of stock, but then some stock out of this 2,50,000 were not sold. So, how much is that? So, you take stock and you see that the closing stock as on 31st March 2019 is 10,000 rupees. The year is actually 2018-19. It started on 1st of April 2018 and it ended on 31st March 2019. So, that is your complete financial year. Profit loss account is for a financial year, for a quarter, for half year, not on a date. That is why the year is written as 1/4/2018 to 31/3/2019. What else you have done? You have incurred transportation cost of 5,000, telephone, electricity bill payment, trade license, you have paid some rent, and there is another item called depreciation. Depreciation is the contribution of your fixed asset. All the fixed assets that you have bought and that is helping you to do the business, you have invested money in them. So, some amount of cost has to be allocated against them, otherwise at the end of the year you will have a false notion about profit, because you have bought a suppose aside from this, or maybe in this example, suppose you bought something, how much, 1,500 rupees worth of fixed asset. Now, if you do not accommodate any expenses out of the fixed asset, whatever investment you made, you have to recover that. So, depreciation is a process of recovering investment made in fixed asset. Another way of looking at depreciation is, it is the wear and tear of fixed asset, meaning that value depletion of the fixed asset. Every year some value will be depleted. At the end of maybe 5, 6, 7 years, you will not be able to sell this asset at the procurement price. That is, there is a depletion of price, depletion of value. So, whatever is the notional depletion of value in a year, that is allocated as depreciation. There is a method of estimation of depreciation, we will see that later, but for the time being, you just presume that there is something depreciation, which is a part allocation of the investment in fixed asset to the total expenses. Now, you started the business with 500 rupees of cash, but at the end of this year you find that there is 800 rupees of cash in your hand. Remember, this is to be estimated. This cash in hand will not be available with you. You have to really estimate what is the total cash flow. You have to estimate the net cash flow during the year and then add it to the previous year's balance sheet closing cash balance to get the cash that remains at the end of the year, and you have to match that cash with the cash in hand to see that there is no accounting anomaly anywhere. Your cash that you count in the counter and the cash that you estimate out from the cash flow statements and the previous cash balance should match. Then there is accounts payable, meaning you have bought something in credit, account receivable, you are supposed to get the payment some other time. So, depreciation is estimated like this. We will discuss about different methods of depreciation and how to calculate. For the time being, just know that if for rate of depreciation for furniture is 5%, you have to just allocate 5% of that as depreciation. There is some mistake in estimation. So, 1500, say 10%, do not consider 5% for furniture depreciation, say it is 10%. So, 10% of 1500 is 150. So, that is the depreciation, that is the allocation from furniture to the expenses. So, at the end of the year, you have to reduce that value out of the furniture's total value that was there in the book. In your balance sheet, earlier balance sheet, you have seen that furniture value was 1500 rupees. So, that is book value. When you mention something in the balance sheet, that remains as book value, because this is the value written in the books of accounts. Now, after 1 year of operation, look at my right, after 1 year of operation, your asset furniture has been depreciated by say 10%. So, depreciation is 150. So, that value has been depleted. So, what is the value after that? 1500 minus 150, that means 1350. That is the money that the 1350 is the book value. This goes into the balance sheet. Now, suppose during the year you bought a billing machine, because there is an employee, you cannot trust the employee to keep the accounts well. So, you want to keep some kind of a billing machine, so that at the end of the day you know what is the inventory at the beginning of the day, how much he has sold, and what is the value of the inventory at the end of the day and at the end of the year as well. So, you bought a billing machine for 10,000 rupees, and then for billing machine also suppose depreciation rate is 10%. So, you allow 10% as depreciation. So, you get the book value of 9,000 after depreciation, whatever is the depletion of the value. So, total depreciation becomes 150 rupees plus 1000 rupees for billing machine. So, 1150 rupees. These are the information available, using which you have to prepare a profit loss account first and then a balance sheet. So, profit loss starts with gross profit calculation. We will start from here in the next session. Thank you.